30 minutes until the start of trading. I'm Matt Miller.
I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, a fragile truce. President Trump vows to keep U.S. troops in the Gulf ahead of talks with Iran.
Meanwhile, crude climbs. Goldman warns that Brent will average more than $100 a barrel through 2026 if the Strait remains closed for another month.
Plus, CoreWeave and Meta strike another mega deal, doubling down on the race to build advanced AI models.
Those are the stocks I'm watching this morning because amid all of the macro stuff, geopolitics going on, this is the corporate news of the day. CoreWeave and Meta, they're both up at least 1.5% in the pre-market. CoreWeave expanding its deal to supply AI computing power to Meta to $21 billion. That was already on top of a previous arrangement of $14 billion. Matt, I had people messaging me saying, like, geopolitical angst, what? Deals are still getting done. AI is still happening. We're not worried about a bubble. Capital markets are wide open.
Yeah, there's a ton. Plus, CoreWeave is selling a convertible bond.
Yep.
Plus, Meta's releasing a new model called Muse Spark.
Plus, Pinto is doing a big data center deal, too.
Yeah, AI is still alive and well. Check on what's going on in markets. You don't see that support in futures. We did have a big gain in the cash trade yesterday, up 2.5%. So we're only down 0.25% now, and looks like investors may be a little bit concerned about the fragile ceasefire in the Middle East. As a result, you have crude bouncing back with NYMEX. This is still for May delivery, back up at $100 a barrel. Brent for June delivery up to 98.58. But that is after the biggest drops for oil that we've seen since the COVID pandemic, since April of 2020. So let's focus in on that ceasefire in the Middle East with U.S.-Iran talks set for Saturday in Islamabad. President Trump says U.S. troops will stay in the Gulf ahead of negotiations, obviously. The White House, though, confirmed that Vice President J.D. Vance will lead the talks. He spoke yesterday.
I think the Iranians thought that the ceasefire included Lebanon, and it just didn't. We never made that promise. We never indicated that was going to be the case. What we said is that the ceasefire would be focused on Iran, and the ceasefire would be focused on America's allies, both Israel and the Gulf Arab states. If they break their end of the bargain, then they're going to see some serious consequences.
Joining us now is Gulnar Motovali. She leads Bloomberg's coverage on Iran from London. Gulnar, on the first day of a ceasefire, we got an attack on a crucial Saudi pipeline. We had Israel launching one of its biggest campaigns militarily in Lebanon, and at the same time, Iran reclosing the Strait. Can we call this a ceasefire right now?
Well, it's certainly looking extremely fragile. And those talks in Islamabad are also looking very tentative. But for now, I don't think any of the sides have said officially that they consider that the ceasefire is done. We've heard that the Iranians have said that they believe it's been violated quite aggressively by Israel. They also said that one of their oil refineries was attacked, and one of their islands in the Persian Gulf was also attacked after the ceasefire came into effect. And then that's why they were then sending missiles to Kuwait, although there's also a dispute over the timings of these things. But certainly it's a very fragile and delicate situation right now, and we have big question marks hanging over whether the Iranian delegation will even be in Islamabad tomorrow, although we've had no confirmation to say that they won't be. But we've also had pushback from various state media, news agencies, that Mohammad Bagher Ghalibaf, the leader of Iran's parliament, who's very important and has gained a lot of power since the war in the leadership structure in Iran, whether he will be there or not.
The former president of the CFR, Richard Haas, wrote on his Substack that this issue, or the issues, can be distilled down into two, right? One, the closure or opening of the Strait of Hormuz, and the other, whether or not Iran is going to be able to continue to hold and enrich uranium for its nuclear program. The first seems like it could be answered depending on the mechanism. The second seems like the two sides are too far apart to figure out a conclusion on the nuclear issue.
Yeah, I think one of the concerning things from the outset is that the points that both sides have, the conditions that they have for a permanent end to the hostilities, much like as we saw in the previous rounds of negotiations that involved Trump's top envoy, Steve Witkoff, and the Iranian foreign minister, they're very far apart. They don't seem to overlap very much anywhere, and that's obviously a concern. And that raises this risk that we'll slip back into this cycle of negotiations that are just destined to not really reach any feasible conclusion, but this time with the added possibility of real military engagement, at least at a low level, just continuing in these cycles. I mean, the other thing is that Ghalibaf, if he does indeed end up leading these talks, that's going to change the dynamics quite significantly, particularly if he's going to be sitting across from someone like J.D. Vance, who's the vice president. That kind of sort of elevates the level of these talks in terms of the officials who are representing the countries. But looking at something like uranium enrichment, from the Iranian point of view, that's quite a technical matter for them, both legally and in terms of their broader nuclear program. But J.D. Vance was sort of using an analogy of his wife being able to skydive. And I'm not sure that's the kind of thing that is going to give many people confidence going into these talks at the outset. They might be talking past each other, which is the kind of impression we were given in the talks that involved Witkoff and Jared Kushner and the Iranian foreign minister in the weeks leading up to the war.
Well, I mean, it seems the Iranians want to have the option to develop a nuclear bomb, and the president wants to take that option completely off the table. That's an impasse, whereas with the Strait of Hormuz, it seems like the president would be willing to make an economic deal. Golnar, we really appreciate your reporting. Golnar Modavelli there out of London. Let's get to the oil picture right now, because we see prices coming back after the biggest one-day drop since 2020. Goldman Sachs says Brent crude is set to average more than $100 a barrel through 2026 if the Strait remains closed for another month. Joining us now is Bloomberg oil markets reporter Mia Gindis. And Mia, we're still seeing crude for physical delivery hold at $125 a barrel, right? Even as we saw futures drop to almost 90 for both Brent and WTI. How does that relationship look now compared to normal times?
Yeah, thanks so much for having me. I mean, in simplest terms, the physical market is trading off of reality, what we're seeing on the ground, whereas the futures market is trading off of what the hopes are for the situation in the Strait of Hormuz a month from now, 2 months from now, right? So the reality is that there is still a virtual standstill in the Strait of Hormuz. There's really fierce competition for oil in the North Sea, and we're seeing pretty extreme product drawdowns in the U.S. And people have been really kind of looking and banking on the U.S. to offset a lot of those supply disruptions that we're seeing to Middle East flows, right? In the futures market, however, like you had said earlier, there's an interest among both camps to restart flows through the Strait of Hormuz, right? So I think there's a hope among investors that in a month's time from now, even if we don't see flows return to what they look like normally, there will be greater movement than there is at the moment. I think we're seeing these days maybe 7 to 10 ships pass through. In regular times, it's around 135 ships passing through the Strait of Hormuz.
Each day.
Yeah. So in terms of where we go from here, because, of course, especially for this American economy, it's not just energy prices, it's also gasoline prices, which are now above $4 a barrel. Well, Matt was mentioning some of Goldman's expectations. What are the expectations of how prices behave from here?
So as far as oil prices, it really depends on where we move forward with negotiations. So a lot of the outlooks that I'm looking at from banks, as opposed to kind of being, uniform with maybe one price and 1 or 2 deviations, depending on sort of what unfolds among markets, it feels like they're very scenario based, right? So at this point, we could rather have the ceasefire extend from, just the 2-week period to sort of endure past that. We could see a reopening of flows in the Strait of Hormuz. In that case, prices wouldn't go back to pre-war levels, because at this point, we have a potential toll booth situation with Iran. We have a premium, an insurance premium. At this point, we have damage to Gulf infrastructure. So in that case scenario, people tell me that prices will likely stay, in the 90 to maybe 100 trend range. But there's also scenarios where the price can go a lot higher from here. So in the case that, maybe talks break down Saturday, there is no sort of consensus in terms of reopening the Strait of Hormuz and restarting flows. If we see a worst case scenario, which some banks have outlined, where we not only see depressed flows in the Strait of Hormuz, but also depressed flows in the Red Sea if the Houthis start up hostilities, we could see prices going much higher from here.
Mia, thank you very much for joining us. That's Bloomberg's Mia Gindis. And joining us now for the next half hour, it's David Kelly, Chief Global Strategist at JPMorgan Asset Management. David, great to see you.
Glad to be here.
When you reflect on the past 24 hours, it certainly felt like a market that priced in a peace dividend. Do you think that was logical trading, just considering, listening to Mia, how many unknowns there are at this point?
I think there is a certain logic to it, because I think ultimately these two issues of Iran's nuclear capabilities and the Strait of Hormuz will get divided, because Iran has got tremendous bargaining power when it comes to the Strait of Hormuz. Every day it stays effectively closed, the price of gasoline goes up, the president becomes more unpopular, he's got a problem maintaining that military force in the region. So the Iranians can just play for time on that issue, and eventually the US will have to settle. And the issue on nuclear negotiations is a very complicated one, and we've argued over this for decades. So I think they'll split up those two issues, and the US will maintain its threat to attack Iran in various ways, including any attempt to rebuild its nuclear facilities, if we don't have an agreement there. But at the same time, there will be, I think, some sort of interim agreement to get the oil to flow out of the Strait of Hormuz. And the way this is going to work is basically Iran will say, well, perhaps we get to levy a toll. I think they're kind of enthusiastic about that. And also, you ship your oil, we ship our oil. And so you end up with that sort of a new status quo where we're arguing forever in Geneva or wherever, or in Pakistan, about the nuclear issue. Meanwhile, though, the world gets back to some sort of normality, some sort of post-war equilibrium with regard to the flow of oil. And that, I think, is what the futures market is pricing in. And I think that's where we're going to end up. And I think so it's reasonable when you look at those long-dated futures going out to December of this year to see lower prices, because it's kind of inevitable that's where we're going to end up. We've got no choice. We have an asymmetric warfare problem here. And the real question, of course, with war is not how do you wage war, but how do you wage peace? And the problem is that a peaceful solution here has got to be one in which Iran essentially lets the world export goods and particularly oil from the Persian Gulf.
So we'll put the nuclear issue aside for a moment. You're the perfect guest to have on because you're the chief global market strategist at JPMorgan, but you're also an economist. Mm-hmm. You've served some time, obviously a long time at JPMorgan, at Putnam, at Lehman Brothers, and you even got a PhD at the dreaded University of Michigan. How does this oil price play through into not only gas prices at the pump, but corporate earnings? Because so far what the market sees is, hey, we're still expecting double-digit earnings growth throughout the rest of the year.
Well, first of all, it was Michigan State, and that does matter in the state of Michigan.
I see. Okay, that's good. Go Sparties. Go Sparties.
I think there'll be some hit to corporate profits for basic retailers, anybody involved in transportation. I think there's going to be further problems for agriculture. But if you look at what's been causing this surge in corporate profits, it really has been the AI push and all the capital spending involved. I don't think that's disrupted too much. I think what we will see, we saw a slightly hot PCE number this morning, but we are going to see a very swift ramp up in inflation over the next 2 months. But because I think consumers are in reasonably good shape right now, I think a lot of these costs will actually be passed on to consumers, and so corporate margins will be maintained. So I don't expect to see, outside of tech, I don't expect to see a collapse in corporate profits at all. In fact, I think the profits of energy companies will probably do very nicely. So I don't expect that overall. I think for right now, the U.S. economy should be able to withstand these impacts.
Delta certainly deciding they can pass along costs. David, you're going to stay with us. David Kelly of JPMorgan. Coming up, more on the U.S.-Iran ceasefire. It's under pressure. Jaina Stroul, a former top Pentagon official, is going to be joining the show next. Stay with us for that. This is Bloomberg Open Interest. President Trump vows to keep troops in the Gulf ahead of talks with Iran as a ceasefire is questioned as to whether that's what we're experiencing. Joining us now is Dana Stroul, a former senior Pentagon official who focused on the Middle East in the Biden and Obama administration. She's now at the Washington Institute for Near East Policy. And still with us is David Kelly, chief global strategist at JPMorgan Asset Management. Dana, how do you view this current state of a ceasefire as attacks in Lebanon continue from Israel and Iran keeps the Strait of Hormuz more or less closed?
Good morning. Well, for the last 6 weeks, we've essentially been in a fog of war, trying to understand exactly what was being targeted in Iran and exactly how much devastation and damage was caused by Iran's retaliatory attacks in the Middle East. And the last 24 hours are it's a fog of diplomacy and a fog of words, where you have the Iranians essentially dominating the information space and maximizing their opening position going into these ceasefire talks on Friday. And this is a typical Iranian play where they will seek to shake up and change all expectations or influence them around the talks. If they even got half of what's on their initial list of demands, it would be a good day for Tehran.
Dana, how do you see this playing out? Because it seems that the administration has achieved its objectives of decapitating the regime. Obviously, it's still the same regime in place, but they killed the Ayatollah. They've hit and degraded Iran's military capabilities severely, much worse than decimated. And as David points out, they're likely to eventually reopen the Strait. It's only a question of what mechanism is used there. Do they charge a toll? Do we split the toll? Whatever. The nuclear issue, I think, is the biggest concern. Like, how do you stop them from further enriching uranium and building even one bomb, or buying enriched uranium from somebody else and building a bomb, considering it's the same theocratic regime in place?
Well, first of all, I think, Trump has said we have regime change in Iran. The problem is we're in an even worse situation. We have a more hardline regime and essentially facilitated an IRGC military takeover of the regime in Iran, who now has experienced the full force of U.S. and Israeli military strikes. And what they've learned in that is that this asymmetric response actually works. It can have severe damage on the global economy, shake up the region. And I think what they interpreted from Trump's tweets and threats leading up to the ceasefire is an element of desperation for him. So in terms of the nuclear program, if you think about the ways in which Iran, its a combination of power projection across the region, the nuclear program, the missiles and drones, and then its support for terrorism across the region, no question, all of those have been seriously degraded and set back, but they're not eliminated. And because the regime is in place and still a hardline regime, there's no indication they're going to change that strategic approach to the Middle East. And furthermore, they just added a fourth arrow in their quiver here, which is that they control the Strait of Hormuz. And so far, whether we're talking about transit tolls, whether we're talking about coordination with Iranian authorities for ships to transit, that implicitly acknowledges that Iran is left controlling an international waterway, which I think is unacceptable and puts them in a very advantageous situation going into these talks tomorrow.
Dana, as these talks get underway here, is the situation complicated by a lack of coordination between the United States and Israel? I mean, is it possible that the United States will be sort of maintaining a ceasefire here, and in the middle of the talks, Israel decides there's just one more target in Iran or in Lebanon that it wants to hit, and that essentially scuttles the talks altogether?
Yeah, I think that's a huge risk, and we actually have seen that play out in the past 24 hours. So as soon as the ceasefire went into effect, at least for the United States, yesterday, I don't think anybody in the Gulf would say this was a ceasefire. The Iranians were still shooting missiles and drones across the Gulf. There were still missiles shot at Israel. And one of Israel's most significant military operations in Lebanon was yesterday, after the ceasefire was announced. I think Lebanese are looking to Iran, actually hoping that Iran can impose a ceasefire on Israel in Lebanon. And this question of whether or not Lebanon is included could actually affect whether or not we get to these talks tomorrow, and that's Iranian demand. So again, Israel's behavior in Lebanon could be this hinge for the talks tomorrow.
Dana, I mean, not even just the coordination between the U.S. and Israel. What about within Iran itself? We have just a minute here, but given the decentralized nature of power there, how does this move forward when maybe you have different levels of leadership viewing a ceasefire, viewing negotiations, viewing how to control the situation on the ground very differently?
I think the lesson of the past 24 hours is that there's still command and control and centralized leadership decision-making in Iran because they agreed to the ceasefire, and within 24 hours, they now appear to be adhering to it. So clearly somebody in authority is making decisions and can deliver a negotiating team to Islamabad should they decide to do that tomorrow.
Dana, thanks so very much for joining us. Really appreciate your intel. Dana Stroul there of the Washington Institute. David Kelly of JPMorgan Asset Management is sticking with us. Coming up, we're going to speak with the CEO of OceanaGold, Gerard, following his company's debut on the New York Stock Exchange. And that company has seen some real appreciation in its price, obviously, amidst the rise in the price of the underlying commodity. This is Bloomberg Open Interest. Quick check on futures ahead of the opening bell. We're seeing red arrows, but they're small, right? S&P futures are down 0.25%. NASDAQ futures down 0.1%, but this is after 2.5% gains in the cash trade yesterday. Likewise, we're seeing gains in crude, but we're still hovering under $100 a barrel. And yesterday, we saw the biggest drops in crude oil that we've seen since April of 2020. So absolutely massive drops, considering the fact that that was a reaction to the COVID, a global pandemic that stopped the economy around the world. So I think really fairly light moves in assets today compared to the massive moves we had yesterday. We'll be right back with the opening bell on the NASDAQ market site in the New York Stock Exchange. This is Bloomberg. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller, and we continue to see, the S&P futures are still down a little bit. NASDAQ futures coming back up to unchanged after we had some really solid gains in the cash trade yesterday. Huge drops in the price of oil, and crude is back up today. We'll talk about that a lot throughout the next couple of hours. Oliver Wyman, a March business, ringing the opening bell at the New York Stock Exchange. The ticker is MRSH, and the stock is up about 50%, including reinvested dividends over the past 5 years. And there are a whole bunch of Filipinos wearing awesome shirts ringing the opening bell at the NASDAQ market site. It's like a Filipinos who work for Microsoft. We're not 100% sure why. I have a Filipino executive producer, and she was like, there's no major holiday in the Philippines right now, but it's cool.
Yeah, it is cool. And someone holding just a whole lot of flags in the back, waving them, for some reason not passing them around.
What do they call those shirts? Because I really want to get one.
I don't know. Producer Ann will help us out with that before we sound horrible. Anyway, stocks to watch this morning. By the way, both of these were up a lot yesterday, and we're just adding to that. CoreWeave expanding its deal to supply AI computing to Meta to $21 billion. They already had an agreement of $14 billion. There's so much appetite here, and Meta's already building out a lot of its own. Both those shares up at least 2 1/3% this morning, Matt.
Yeah, there's a ton of news around those two companies, a lot of news around AI, corporate news that we welcome after basking in the macro for so long. A check on that, though, right now, the broader markets and oil. Obviously, you can't look away. S&P is starting the cash trade down just a little bit. NASDAQ, too, but not much. NYMEX crude up 5% at $99.31 a barrel. Brent at $98.10. So you still have WTI, the front month contract, higher than the front month for Brent, but that's because they're different months. As we continue to tell you, NYMEX front month contract right now is May, and Brent is June. So we're waiting for that change to happen. But the important part is that oil for physical delivery, Dani, I was looking it up on using Ask B this morning on the Bloomberg terminal. It's still over $124 a barrel.
That's a lot. And it's this disconnect between paper and physical markets. And even further out the curve, David was talking about this. You get this real steep drop off in pricing.
Yeah, David Kelly is still with us. Fortunately, JPMorgan Asset Management Chief Global Strategist. And what do you make of these markets, David? Because we're still we're down year to date, but only like 0.9% on the S&P. So even throughout the AI disruption fears, the private credit withdrawal requests, and a war in the Middle East that caused the doubling of oil prices, stocks remain near record highs.
Yeah, I think it is really important to understand sort of changes in the structure of markets in recent decades, which is only being amplified right now, which is really helping the market be very resilient. So last year we had $1 trillion of stock buybacks, only $600 billion paid out in dividends. All those stock buybacks, that's money on the table buying stocks. We've got about $11 trillion worth of defined contribution 401k plans. That's money waving into stocks every day. We've got an increase in inequality. Richer households, they don't buy goods and services, they buy financial assets. That's money going in. So we've got this huge wall of cash going into the market week after week after week. So you really need something really bad and scary in terms of the economic or geopolitical situation to actually cause this market to correct. And so I think the market, if consumer sentiment is way underestimating the economy, I think the market is way overestimating the economy. It's really not reflecting the economy we have. But I think it's reflecting just a lot of cash looking for home in stocks.
Yeah, I mean, Dani, we're going to have Anurag Rana on later to talk about CoreWeave, and they've just done, well, now collectively, $35 billion of deals with Meta alone.
Huge.
They're selling convertible bonds, right, to set up these data centers, and I think I saw the coupon at 2%.
Right.
It's nothing.
It is.
Investors will just throw money at anything now. No wonder private credit isn't that bad off.
Even in a 100-year bond from Amazon, Robert Schiffman had a great note a couple weeks ago from Bloomberg Intelligence basically saying that we think that there's too many bonds. Actually, there's not enough of them. There's so much demand for this. I wonder if that's also compounded by the fact, David, there's a note from Nomura's Charlie McElliott saying that we're also just really well hedged right now and that we're over hedged to chaos, and that's also keeping a floor in markets.
You can't hedge to chaos because you can only hedge against a known risk. And what we've learned from this century, I hope, is that you really don't know where the next hit's going to come from. 9/11, Lehman Brothers taking down the whole global financial system, the pandemic.
You remember Lehman Brothers?
Well, yes, but there's a broad issue here, which is in every dimension, technology is getting more powerful. Whether it be military technology, biotechnology, the financial technology, and these technologies, unregulated, will blow up and cause fat-tailed events which bring markets down. And how do you hedge against the next problem when you really don't know what direction it's going to come from? To me, the only way to hedge risk is to diversify.
I mean, that's true. If you wanted to hedge on after a President Trump's tweet saying something like the end of civilization, I don't even know how you would treat that, David. I mean, it's...
Well, first of all, you have to make an assumption about, how much are you really going to how much you're going to bet on that.
Yeah.
But also, broadly speaking, you have a very diversified set of assets, and you also look carefully at valuations. The two things that can get you are, one, not being overweight one side or the other, and two, just being overweight something that's way too expensive. So I think people need to look at valuations, and they need to look at the spread of their assets. But so long as you're spread around in things that are reasonably valued, you should be able to ride out most shocks that could occur.
By the way, I just pulled up your bio to see. You were already gone from Lehman Brothers.
It was not my fault.
Yes, exactly.
I was out of there a decade before they bought all those.
We won't hold you responsible.
Thank you.
Listen, I'm hearing conflicting things about market positioning. So Dani and I were wondering a couple weeks ago why software and services was doing so well. And I guess traders were telling her, like, CTAs were trying to get flat because they had been so short, so that was like short covering. But yesterday I saw a note from trading desks, a number of trading desks, saying that you're going to see more of that, and so it should power a rally higher now.
By the way, software was down 1% yesterday when everything else was up.
Right, but Charlie McElliott says, everybody's hedging to chaos. I talked to Max Kettner at HSBC, and he said market positioning is so clean right now. Like, how is this market set up?
Well, trading is of course a nightmare. But from an investment perspective, we've seen a huge sell-off in software because of the capabilities of AI. But I think we have to take a step back. I mean, people are not going to design their own payroll systems in their garage. I mean, there's just the whole issue with technology today is how do you integrate technology into your business? The business of integrating all these incredible technological capabilities is very important. And in many ways, what software companies do is they come up, okay, this is the very best way to deal with the problem that you're facing. And they think a lot about, what's the color of the dashboard? How do we position things? How do we make this as suitable as possible? So I think there still will be plenty of market for that, even if AI does technically have the capabilities to do a lot of this in a rough way.
I was actually talking. I talk about this a lot with my wife because she works in a software as a service company, and so a lot of people in our social circle do. And someone else, not my wife, pointed out that a lot of these big corporations, maybe they could design systems that would do things like payroll or CRM, but they always want to have a scapegoat. If something goes wrong, you always want to be able to blame a third party or a vendor rather than having.
Well, that's right, and you also have to concentrate. You have to constantly focus on your core competency, your core edge, and your core edge may not be designing back office software systems.
Right. Otherwise, Meta wouldn't pay CoreWeave $35 billion to set up their data centers.
Technology will adapt. So it's really important just to look at good companies, but don't assume that everybody's going to be doing it themselves, because I don't think they will.
David, this has been great. We have to do this again sometime. Thanks for spending the past half hour with us. David Kelly of JPMorgan. And let's get a check on your equity markets right now, more than 8 minutes into your trading day. And we are just barely lower after a huge day yesterday for these markets. A big rebound that's left us just within 3% of all-time highs, despite everything. And we are looking at big tech having a good day. Meta is higher. Matt was talking about that deal with CoreWeave. Broadcom, Amazon, Micron. A good day for the chip stocks. SanDisk getting an upgrade from Bernstein, saying that a blue sky scenario could see that stock go to $3,000. It's currently at $818. Some of the energy companies doing well too. Microsoft, Alphabet, those are not having a good day. Same with Palantir. Those shares getting crushed, down 4%. Eli Lilly, MasterCard, Oracle also having a down day. Looking at the sectors, utilities are doing really well, but that's the energy, clean energy, alternative energy companies within them, like Vistra is one of the top of the pile in utilities. Energy does well as the price of oil rebounds this morning, followed by materials. On the downside, financials, Goldman Sachs is going to be kicking off earnings on Monday, followed by all the other big banks, so that will be interesting to see. Again, Matt, overall markets slightly lower this morning.
Yesterday felt like such a hard rally, didn't it?
It did feel like a hard rally. But, I mean, we always it's normal to give things back.
We haven't been up that much since last Tuesday.
I know, that is the crazy thing. The last time the rally was so big was March 31st.
Coming up, CoreWeave and Meta strike another massive deal to the point where we're just getting numb to these numbers. But I think it's encouraging to see that they're still looking to a third party to do stuff. That tells you a lot, as David Kelly was just saying, about software as a service as well. This is Bloomberg Open Interest.
Going a whole lot of nowhere yesterday after the biggest, today after the biggest rally yesterday, the biggest in about a week. S&P and NASDAQ, little change this morning. NASDAQ slightly higher with Brent crude inching back towards $100 a barrel yet again. Time now for our top calls. The analyst action where we are watching. First up, Morgan Stanley. They've upgraded Alcoa, saying higher aluminum prices from tight Middle East supply will boost earnings and drive strong cash flow. Next up, Raymond James. They've upgraded Instacart. They say that grocery is an under-penetrated e-commerce category and is set to benefit as shopping becomes more automated. And finally, Stifel upgrades Texas Instruments to a buy. They say demand for its everyday use chips is starting to rebound and should drive growth. Shares up nearly 2%, Matt.
All right, CoreWeave expanding its deal to supply AI computing power to Meta. $21 billion is the new deal, building on a previous agreement of about $14 billion. Joining us now is Anurag Rana, Senior Technology Analyst for Bloomberg Intelligence. And Anurag, the first question I have is very basic. I'm not sure if I understand. Does that mean it's a total of $35 billion in deal, or are they expanding the $14 billion deal now to $21 billion?
I think it's expanding the deal from 14 to 21, but still, it's a lot of money. It doesn't matter if, either way, it's a big commitment by Meta to say that, we are going to invest more in either training the models and being competitive in that area. And they're going out to neo clouds such as CoreWeave for it. We've already seen how Nebius has done well in the last, few months. And, it's the same extension of that concept that if you can't build it in-house, you're going to go out to these, neo clouds to get the GPU as a service work that you need.
Well, and they're still trying to build it in-house. Anurag, just how constrained are these hyperscalers still? How much more do they need? As Matt was pointing out, it's like every other week we get a headline of some crazy multiple tens of billions of dollars deals being done for these data centers.
See, everybody is constrained. It's not just the hyperscalers. Even Nebius and CoreWeave, they are also constrained in it. But you have to remember one thing, and we just learned again from the AWS, the Amazon letter today, they are seeing a level of demand that they have not seen before. And this is something we go back on our work that if you look at the backlog of deals, we have seen, you could say cloud commitments north of 1 trillion. I think it's north of 1.5 trillion at this point from everybody. Microsoft, it's over 600 billion they have on their balance sheet that needs to drop into, sales. So everybody is getting those backlog orders either from just the model companies, or they're also coming from enterprises that are infusing more AI into their daily work.
Why doesn't Anurag Meta build these data centers itself? Because clearly they have the money. I'm sure they could figure out the capability, looking at what Mark Zuckerberg is doing to build new AI models. And if we're worried about big American corporations like building CRM software in-house, why wouldn't they build data centers in-house? Why outsource this to a third party, to a neo-cloud company?
So when you look at all the hyperscalers, they're doing both. It's not that they're not building it in-house. They are doing that. But at the same time, there may be some workloads that they only need for a temporary basis. So for example, if you want to train a large model right now and you're looking at a commitment for the next 3 years, you will go outside because after that, you don't need that capacity. But let's say you're doing inference work and you're looking at all the stuff that's coming from your own applications. You want to host it because that's a very long lead of that AI workload. As far as CoreWeave and Nebius are concerned, they will be looking at and saying, right now we're going to be working with these clients to build capacity, but we also know down the road more inference work is going to come from those people who can't build it in-house. So it works for both of them.
We also heard from Andy Jassy in his shareholder letter, basically saying he has a strong conviction for Amazon that we're not overhyped the technology, that we're not in a bubble, and that margins and return on invested capital will be appealing. So, Anurag, I guess Amazon is still going full in. Have we moved beyond that bubble conversation? Because it feels like we're on the other side of it, worrying about software, that the technology is so great that it's going to disrupt everything.
Yeah, I think he's basically giving a signal that his capex is going to go up more. We had published a note yesterday saying that, looking into the next earnings and even beyond that, we think Amazon Web Services sales growth is going to improve. When you look at Anthropic going from $9 billion in revenue by the end of the year to 30-odd billion within, I don't know how many months, Amazon Web Services is their primary cloud provider. So you're going to see some kind of acceleration in that particular growth rate. The big question is how capacity constrained is everybody? How many chips do they have in their hand? And Amazon has a slight advantage because they have their own chips Trainium that they are really getting ready to, I would say that at this point, I won't anyway close to at par with NVIDIA, absolutely not. But, they're coming close to doing a lot of the work for some of these cloud providers. And I think that you're going to see some of that benefit coming in.
Anurag, always great to spend some time with you. It's not often enough. We need to get you more often on, right?
Totally. Anurag's one of the best. We have to have him on more.
He's the best. Anurag Rana, senior technology analyst for Bloomberg Intelligence, unfortunately in Chicago. We need to move him. We need to move him back to New York.
I don't know how Anurag would feel about that.
Better city, too. Coming up, Wall Street Journal reports that Disney's new CEO, Josh D'Amaro, is making one of his first significant moves by firing 1,000 people. That's next. This is Bloomberg Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Let's get a check on what's going on in stocks today after a fairly face-ripping rally yesterday. We see stocks down just about 0.2% in the cash trade on the S&P and the NASDAQ. So not huge drops. We do see crude, both New York crude and Brent crude up strongly, and now we have WTI up over $100 a barrel. We're going to talk about oil in this hour, and some analysts have told me already this morning that that's because there's so much demand for U.S. oil as the Strait of Hormuz remains blocked. CoreWeave right now down 1% after it made a deal with Meta to expand its AI data center supply to Meta to a $21 billion contract. Now, there's also a story about convertible bonds that it's issuing today, and that may be weighing on the share price. Meta up 2.5% as it releases also its new avocado, like the public version of avocado, which will be called Muse Spark. That's the large language model that it's making. Constellation Brands up 4%. Because who doesn't need a shot of whiskey right now? And Disney down 1.5%. We're going to talk about that, Dani, right now, because it seems like the new CEO comes on board and his very first move is to fire 1,000 people.
And maybe more whiskey purchases ensue after that. Yeah, it's the Wall Street Journal reporting just weeks after the CEO, Josh DeMario, took the helm. Joining us now to discuss it is Bloomberg Tech co-host Caroline Hyde. Caroline, Matt's been saying this quite punchy for one of the first big moves of a new CEO to come in and fire 1,000 people.
Likely underway before he actually even took over the reins. And this is as they really start to reimagine, and in fact it's called Project Imagine, which is a little painful if perhaps you're the one who's on the chopping block. But it's all about marketing, reducing silos. It was actually at the beginning of the year, in January, that we saw Asad Ayaz get the first ever sort of chief marketing officer of the whole of Disney. Before he'd been all in on the studio side, but now he's doing theme parks, he's doing the whole shebang. What does that mean? Well, he's consolidating his entire marketing executives. He's making sure that they see it as an across business look. Well, that likely means you can do more with less, more efficiency. We think about how AI is disrupting marketing in particular as well, but it means as though maybe 1,000 people are going. Remember, 8,000 people have gone since we saw Bob Iger take the helm back in 2022. So they have been trying to restructure an awful lot. This is a business that isn't as profitable as it used to be in the streaming side of things. So they've got to try to make cuts where they can and plow divisions, more money into the theme parks and the areas of expansion.
So hard to believe that they're not doing that well, since I spend so much money at Walt Disney World. I spend so much money on the Disney cruises.
There are quite a lot of people.
As much money as I can on the streaming service.
Think of the labor costs on those.
I just bought a new Anna costume.
If only there were
yesterday.
more Matt Millers in the world.
Well, I get that. How many people are in the marketing division? They have enough people in marketing to fire 1,000 people for marketing?
I mean, this is a company that has 280,000 people, employees, but actually most of them were there busy putting makeup on your child to look like Princess Anna when you're on the Disney cruise. Most of them are serving you when you're getting on the latest roller coaster. But there are a lot of people in the corporate center, and that's where they have been trying to take a lot of people out of the business. So, yeah, clearly there is a consolidation that can happen under Asad Ayaz, and he's trying to reimagine the way in which he can do business and brand opportunities and just speak from one side of the equation to the other. Just make more bang for the buck when it comes to marketing. Clearly there are a lot of people in it.
Is it something about just this time, too, where there are less Matt Millers in the world because the consumer is under pressure and people aren't spending as much and margins are getting hurt? Or is this just a continuation of the Iger project of slimming things down?
I think it's a continuation, is what many people would say. The reporting from the Wall Street Journal is that this was underway, already being enacted before Josh DeMario took the reins. But it is a painful legacy that he has to keep on bringing on board. How is he going to rethink the entire business? Where are his areas of focus? Of course, he comes from parks. And he's a man who's going to want to keep on expanding out those rather new boats that lavishly the odd person is be able to spend a little bit of money and go on. Which one were you on, by the way?
The Disney cruise?
Yeah.
It was like a four-night cruise from Fort Lauderdale down past the Bahamas.
You did some dolphins.
To like Bob Iger Island. And
we did it last year. It was amazing.
I loved it. I was
fantastic. Was a cynic. I was like, I'm going to hate this. And then you do it and you're like, oh, I get it.
Samesies. I thought, no, I'm not a cruise guy. But now I'm a cruise
Disney
guy.
Adults.
Caroline Hyde, catch her on Bloomberg Tech at 11 a.m. New York time. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I am Dani Berger. Stocks come in after a rally of more than 2% yesterday, struggling for direction as the geopolitical headlines and the price of oil dictate everything.
Coming up, a fragile truce, I should say. President Trump vows to keep U.S. troops in the Gulf ahead of talks with Iran. I keep reading that headline all morning long, and obviously, right? He's not going to move everybody out of the Gulf while we negotiate. So
no, but I think the point is that he's like, we're still here, even if there's a truce, we're ready to do something. It's, you know, the threat that he holds over negotiations. Elsewhere in corporate news, a blockbuster deal that's set to reshape the global food market. McCormick CEO Brendan Foley joins us this hour after a huge deal with Unilever.
Plus, a controversial take from billionaire Thomas Peterffy. He says there should be no bans on insider trading.
Yes, and we're going to talk about that, and that I'm really interested too, because I don't fully get it, but maybe Joe and Tracy.
Well, and he owns a trading business.
Yeah. I mean, he's not advocating to do insider trading on his platform, but he's just like, we should remove
He thinks regulators should allow it, I think is what he said on Odd Lots.
It is what he said.
The Odd Lots podcast, the new edition, just came out 4 hours ago. So not a lot of people have had time to listen to the entire hour of it, including, I think, either one of us.
Yeah, I listened to the bit about insider trading, though.
But okay, so did I.
Yeah.
And we have Joe Weisenthal and Tracy Alloway, who actually did that interview, coming on the program.
So that's later this hour, but we begin 10 a.m. with a fragile ceasefire. Vice President J.D. Vance will lead a U.S. delegation for direct talks with Iran and Pakistan this weekend. The vice president spoke yesterday.
I think the Iranians thought that the ceasefire included Lebanon, and it just didn't. We never made that promise. We never indicated that was going to be the case. What we said is that the ceasefire would be focused on Iran, and the ceasefire would be focused on America's allies, both Israel and the Gulf Arab states. If they break their end of the bargain, then they're going to see some serious consequences.
Joining us now is Wayne Sanders, Bloomberg Intelligence Senior Defense Analyst and retired Army Colonel. Colonel, how are you viewing these ongoing negotiations and talks and the ability for there to be any sort of breakthrough or real agreement to a ceasefire that ceases hostilities and allows the flow of traffic through the Strait of Hormuz?
You know, I think I told you guys a couple of times ago on this show, really it comes down, in my opinion, to missiles, money, and monitoring. Those are the three things that President Trump had really pushed for originally off. The missile side of the house is missile production, not being able to keep those in. Money is actually part of it saying they can't continue to fund their proxies, and then monitoring for the nuclear side of the house, right? So two of those, between missiles and money, those are two of the things that Hezbollah on their side, they support in Lebanon. They do that. Hezbollah, it's their most effective proxy. They fund, train, and equipment directly to Hezbollah, and it's a primary military lever. So I understand from Vice President Vance, I understand where he is talking about right now, saying I don't see how this could possibly be in the negotiations.
We've been talking a lot about this, obviously, this morning and throughout the last couple of months. It seems as though we can get to a solution for the Strait of Hormuz. It depends on the mechanism, if someone gets paid, how that revenue is split up, whatever. Is there any way to get to a resolution on the nuclear side that's better than JCPOA?
Yeah, I don't know, especially without putting boots on the ground and verifying a lot of this, right? You know, you come to the nuclear dust conversation that was yesterday, really looking at being able to dilute it on whether or not you can actually bring it down from 60% grade, which is with the weapons grade, and bringing down towards the 20, which is more on the nuclear side. You can do that through depleted uranium, through something called down blending. But these are pieces tied to that monitoring side of the house that they would have to come forward and be very much more transparent now than they were prior to the conflict, where they were kicking the IAEA out to even come and see Natanz, Fordo, and Isfahan.
All right, Colonel, great to get your take on this. We'll continue to talk about it as these talks kick off on Saturday. Retired Army Colonel Wayne Sanders there, now with Bloomberg Intelligence. Joining us to talk about the market reaction is Stephanie Gill, Chief Investment Officer at Robinhood. And Stephanie, we've seen this market yesterday rally pretty hard. Today it's off a little, but we're back to only down 1% year to date. We're not far off at, 67.76 from record highs here, even though this year we've had the AI disruption issues, the private credit worries, a war in the Middle East, the doubling of oil prices. How do you explain that to investors?
I think because when you look at earnings expectations, they've actually even gone up over the last month. And that, to me, that actually makes me a little more nervous more than anything else. And I think the most important thing to look at from here is actually commodities and the impact on businesses. And that, I'm not sure that's fully priced in. Like, yesterday I was like, last week when the markets were down a lot, I'm like, okay, this might be actually the bottom. And it was probably a dip buying moment. But I do think that the flow of commodities is going to be the most important thing. I don't care about the missiles. I don't care about any of that stuff. I mean, for human sake, I do.
Of course.
But from an economic perspective, I do think if we don't get the commodities flowing in a faster pace, like that will actually, you might see a second dip.
Well, one of the arguments I've heard as to why that matters less is because companies can preserve margins because people will still pay up. And they point to Delta as an example that can raise their prices and everything is fine. Can that act as a sort of antidote if there is still an issue with the flow of commodities and the price of energy?
My desk and I, we were talking yesterday about the Delta earnings and how they got kind of lucky, I think, to post their earnings on the day that they did because it was sort of an everything rally and people were willing to forgive the fact that they missed on guidance. I don't think you're going to have that in every single category. I think not everyone will pay up because the consumer already, we have the K-shaped economy issue, and that's going to get worse for the lower end. So I'm not sure it's going to actually play out in every single
How much can these, we're talking again today about an AI data center contract that's worth double-digit billions, right, with Meta and CoreWeave. How much can this AI spending really power the whole market? Because there are many stocks that aren't even indirectly affected by that.
Well, I mean, if you think about, like, when you say the market and you look at the S&P 500, it is still dominated by technology. And I think that's why it can still power the whole market, because it is a rediscovery of building infrastructure. And, that takes lots of different names. Like, a name like Flowserve is a name that we've liked before, and now it will probably also benefit from some reconstruction in the Middle East. So I think you can still see, like, powering the economy outside of even just the tech sector. But tech is obviously, like, still the strongest sector now. And I don't think it's the top 10 names. I think it's more of like the next level down.
So which are those? Is it like chip makers, that sort of thing?
To me, it's more like the optical names, like a Coherent. They've been flying high despite what's been happening in the Middle East. Marvell Technology is another name that we like a lot. And then Flowserve, I mentioned, is the one that's kind of more the reconstruction and makes all the pumps and things like that.
How do you see this market positioning right now? Because we've heard on the one hand that the jump in software and services stocks over the last month was because CTAs were trying to get flat, as we go to war in the Middle East. On the other hand, we've heard trading desks say that the market is still very short, and that's why we're going to see this rally powered higher. So how does the market positioning look to you?
I think it looks pretty even keel for me. I think you do need to have, like, that's why I said keep watching what the commodity prices are saying to us and the flow of commodities, because I do think that's going to have an impact. I think the net shorts are kind of mostly washed out, but I don't think anyone's going like full bullish right now. And so that could also be a short term if, this ceasefire ends up being something real and you do start seeing like going back to the many double digits through the Strait.
And maybe we'll get some more information when we do start hearing from more of corporate America. And it really kicks off in earnest next week. Goldman Sachs reports on Monday, specifically for the financial earnings. What are you watching out for, Stephanie?
I think it's mostly about the consumer. I mean, I was worried about the private credit sector. I do think it's something that can sort of muddle through. So I do want to hear what they say about that and all the different banks, but I think they can handle it. It is more just about the consumer and whether they're seeing their spending pull back because gas at the pump is at least $1 more a gallon.
Is that going to affect the Trump baby accounts? I note that Robinhood is going to be working with the administration in this. How big of a product do you expect that to be?
I think it'll be pretty popular. I mean, it's such a meaningful thing. I think it really is one of the best things that we can do as a country to help shepherd the next generation into the financial market and have them really actually saving for every single kid, like not just the ones that parents can afford it. I mean, I think it's one of the best things I think our administration is doing.
All right, Stephanie, we're going to have to end it there. Thank you so much for joining us, Stephanie Guild of Robinhood. Just want to bring you a quick line, by the way, on private credit. The Wall Street Journal reporting that Carlyle, one of their flagship private credit interval funds, has seen requests of 15.7% of shares to redeem. That is more than 3 times the 5% limit. I'm trying to see just to what degree they are meeting that. But either way, that is a very, very large redemption request, Matt. Again,
nothing compared to 40%, though, right? Didn't
no.
one of the
that was one
funds?
I mean, to be fair, it was a pretty small fund, but it was their technology fund. Saw nearly 41% of redemption requests, and they were like, absolutely not. We'll give you 5%.
All right, so we continue to get these private credit headlines rolling in. It doesn't seem to be roiling the market. We're still seeing the S&P 500 down less than 0.2 of 1% right now. Coming up, OceanaGold's now trading on the New York Stock Exchange. The CEO, Gerard, joins us on what it means for investors and where gold is headed. That has been a huge question, especially over the last couple of months. This is Bloomberg Open Interest. Let's get now to high interest. Look what's making headlines around the world. China quietly stepped in to help secure an Iranian ceasefire using its economic leverage and ties across the region. While President Trump credited Beijing, China hasn't confirmed nor denied its role. The move signals a rare shift from China's long-held preference of staying neutral. Wall Street banks are set to post a record $18 billion in stock trading revenue, fueled by market volatility tied to the war and AI uncertainty. Goldman, Morgan Stanley, and JPMorgan lead the surge as investors reposition, but attention is shifting to risks, especially private credit exposure and what executives signal about the future. And a tiny shipping ETF is suddenly a real-time war meter. The Breakwave tanker ETF has skyrocketed 1,300% as Iran tensions disrupt oil flows through the Strait of Hormuz, spiking tanker rates. It's the best performing U.S.-listed ETF so far this year. Despite the gains, the fund has attracted only about $25 million in net inflows, possibly due to high fees, complex taxes, and its niche exposure to tanker freight. So not really a huge player.
Yeah, I was going to say a huge gain, but like on no liquidity. Maybe.
Yes, that happens.
Yeah, that does happen. Elsewhere, Matt, OceanaGold rang the bell on the New York Stock Exchange earlier this week, a move aimed, listing there, at widening its investor base and boosting its liquidity beyond Toronto, where it was listed before. And it also comes as the gold story shifts. North American production is under pressure while global players gain ground. Joining us now is Gerard, CEO of OceanaGold. And I feel like this is especially interesting to bring up, this idea that there's less coming out of the United States and it's happening globally because you have a huge presence in South Carolina. How is that operation going? How does it compare to what you're seeing globally?
Well, look, it's our largest producer. This year it's going to produce 45% of our gold production, and it's growing. I don't know what's going on in the rest of the USA, but this year the Hale gold mine in South Carolina is going to produce 35% more gold at a 25% lower cost than it did last year. So its production guidance is sitting around $1,550 per ounce. Gold's there at $4,600 an ounce. We're going to produce 245,000 ounces. That's a really meaningful producer of gold.
It's massive, and obviously the price of gold has been accelerating to a level that's eye-popping. What are the cost inputs there? Because I gather that energy is an extremely high cost or high part of the cost of producing gold.
Well, across our business, and Hale's no different, energy is about 16% of our total cost. So 8% is around electricity, 8% is diesel. We hedge our diesel 12 months out in advance for Hale gold mine for about 80% of it. So we're not suffering any material impact on our cost base as a result of the increase in oil prices.
What difference has just the pure volatility in gold prices meant for you?
Well, it's meant increasing margins, right? This time last year, gold was $3,200 an ounce. Today, it's $4,700 an ounce. And that we've been able to take that high, strong gold price straight to the bottom line. Last year, we had record financial performance. We had return on capital of 15%. We had record profitability, record free cash flow. This year, we've increased our dividend threefold. We've increased our share buyback by 100%. And we're still able to add cash to the balance sheet. So we're in this unicorn situation of being able to sustain the business, grow the business, increase exploration, double the amount of direct capital that we return to shareholders, and still build cash. It's a fabulous time to be in the gold space, and we're uniquely placed.
And I mean, you've been rewarded for it. The stock has been on fire, as I noted during the commercial when we were talking. I see it up 650% over the past 5 years. That's total return. Do you, when you see gold, the price of the commodity, go to $5,000, do you hedge that as well by selling future of what you get out of the ground in the future?
Some gold producers do. We don't. Our belief is that our investors want that exposure to the gold price. Our EBITDA margins are in the order of 60%, so you don't need to. We don't need to protect ourselves. We have no balance. We have no debt. We have $500 million of cash in the bank, and so we see no need to hedge gold price. Our shareholders want that exposure.
There had been some very strange dislocations in gold markets, especially when tariffs were announced between European and U.S., where you'd get planes loaded with gold coming to the United States. There was this real frenzy around it. Do any of those dislocations still exist in the market, or is it sort of a more normal operating environment now?
Yeah, look, there has been some movements, and a lot of central banks around the world have sought to have their gold repatriated and being located in country for those reasons. It doesn't really move the gold market as such. That's like the location of where the gold is stored. It doesn't alter the price. What has happened after the Iran conflict flared was that some central banks around the world did liquidate their gold positions. It's very liquid. That's one of its great attractions to help support their currencies, but that's stabilised now too.
Does that not, though, make gold that's already here more valuable than gold that's in other places?
It's a global market. It's also a very liquid market. I think where it's stored doesn't alter the price of gold.
So you had mentioned that you're going to bring operating costs down by about a quarter. What are those costs? Where are you able to find that extra margin from?
Yeah, well, I was talking about our unit costs, and as I said at Hale, we're increasing our production there by 35%, and so we absorb fixed costs. And again, the gold price is now, this year, 30% higher than it was last year. And last year was a record financial year. So we have this unique circumstance of 30% higher gold price, lower unit costs, higher volumes. It's a great cocktail.
Can you wring out more gains using artificial intelligence? Or in discovery, can you use artificial intelligence to find new Hales?
Our industry is very complex, and there's a lot of data, and we are working in parts per million. So short answer is yes. We use it for exploration. There's a lot of data out there, and if we can use AI to help us target the drill rigs, yes. The biggest gains that we see are in the process plant, where again you're taking grams per tonne material through a complex chemical process. And if we can fine-tune the knobs using AI to optimise that flow sheet and that flow rate, we can get better yields. And also in maintenance. Maintenance is one of our largest expenses, and if we can use AI to predict when equipment needs to be taken down for repair, that's also a source of future value.
What do you think about the role of gold for an investor? I mean, you're obviously focused on finding it, bringing it out of the ground, but you must contemplate quite often, I imagine, whether it's an inflation hedge, why we would see it, for example, drop in a time of war rather than rise in that kind of uncertainty.
It's going to replace the dollar for all central banks.
Yeah.
Look, it's got a very broad purpose. I mean, 50% of gold over many decades now has been bought by Indian and Chinese customers. Is it jewelry? Is it store of value? Is it wealth protection? Central banks have been very large buyers since 2022, post the invasion of Ukraine.
I believe global central banks now own more gold than treasuries.
Yeah, very liquid, and it's very liquid as well. The ratio of trading of that gold to the underlying stock of gold is very liquid, and that makes it one of the attractions. It's been a wonderful thing for people to have had in their investment portfolios, whether gold or gold equities. But as we were talking before we started the show, gold equities, and our gold equity in particular, has performed far better than holding gold. You get much more leverage to the gold price by owning a gold producer.
Right, the gold price in 5 years is up 150%, and as we said, your stock price is up 650%.
Correct.
So.
Yes. Gerard, thank you so much for joining us again. Congratulations on your New York Stock Exchange listing. Gerard Bond, CEO of OceanaGold. Still ahead, another corporate story for you. We're going to speak with McCormick CEO Brendan Foley on a huge deal with Unilever, $45 billion. That's coming up later this hour. You're watching Bloomberg Open Interest.
going to check on the stock market right now. We are looking at still a loss, but only 0.2% after a 2.5% gain yesterday. We're down 14 points, and we're pretty evenly split here. 221 gainers, 278 losers. On the green side of the ledger, Amazon adding the most points right now, but you've got Facebook moving higher, as well as Broadcom, ExxonMobil, Lam Research, and Berkshire Hathaway. On the downside, Microsoft, even after its Filipino employees rang the bell at the NASDAQ market site, Microsoft down another 2%. It's had a rough start to the year. Google is a loser today, as well as Palantir, Apple, and Tesla. Looking at the breakdown in terms of industry groups, you've got utilities and energy leading the market in terms of gains. Consumer staples, real estate also up. At the bottom of the list, you have IT, so those tech stocks are down, as well as healthcare and financials. Coming up, McCormick spices it up with a bold bid to acquire Unilever's food business and my very favorite mayonnaise of all time. The CEO, Brendan Foley, joins us next. This is Bloomberg Open Interest. The spice giant McCormick is betting on scale, moving to combine with Unilever's food business in a deal aimed at building a global flavor powerhouse. The key question is whether investors will have any appetite for it. I know, a lot of puns here, but I'm here for it, and for the spices, because I love to cook, and I spend a lot of my day in the spice aisle at ShopRite. I spent a lot of days at ShopRite. Joining us now is Brendan Foley, Chairman and CEO of McCormick. Brendan, great to have you. Really appreciate you coming in. Talk to us first about this deal, because it is a massive deal, and I guess you'll back into a company that still will have a majority of Unilever shareholders, but you'll stay on running the business and keep your headquarters.
That's right. This is a combination really focused on growth and value creation. So you have two iconic brand portfolios combining to really create just a preeminent, food company that's all focused on flavor. And so when we look at this, it's going to be very accretive in the first year. Sales, adjusted operating margin, adjusted EPS. And so we really think there's a lot of value creation opportunity here. But it's also, an opportunity for McCormick just to continue to kind of that strategic focus on flavor at a global level.
It does feel a little bit counter to the overall trend of what's happening with consumer products. Kraft Heinz paused a split, but still is looking at it. Keurig Dr. Pepper, this is moving in the opposite direction. Are they getting something wrong? Why do you think that you're growing bigger as others are trying to do spin-offs or shrinking and focusing in on various parts of their business?
For both Unilever and McCormick, this is about focus. And, we're really bringing together a number of brands. Again, as we said, they're all focused on flavor. And that's what McCormick's focus is. And we bring the focus of a food company now to that brand portfolio that we're combining with Unilever. But it is really about focus in both companies.
So I want to focus on the flavor, too. I have a million questions about your products. But I want to ask first about the deal, because the structure is interesting. It's a reverse Morris trust. I don't know what that means. But tell us about the mechanics of that and why you decided to do it this way.
Well, as we combine both companies, you think about the size of Unilever. It's about 2/3 the size of the total combined. And McCormick is about 1/3. And that's really the combination that we agreed upon in terms of the proportion for both shareholders. But both shareholders win in this. What they get is a larger food company that's faster growing, with stronger margins, and an ability to really build out globally.
Well, and Unilever is a monster business, but they must have a lot of faith in you and your management team, because otherwise they would, obviously replace you.
McCormick is the right home for these brands. Yeah. And when we talked about it, the equity fit of the focus of their portfolio, which is brands like Hellmann's and Knorr, and other brands that are also local favorites, combined with McCormick, it's a really strong fit when you think about the grocery store.
It is a big project to take on. What becomes sort of the pain points of an acquisition, of a deal, of a reverse Morris trust of this size? What needs to be worked through in the coming months and years?
Well, the important part is how you plan integration. So we have a very detailed integration plan that we have underway, and we have a lot of experience in doing this. Of course, not necessarily at this size and this scale, but when you look at an integration, it's important to define the complexity that you're dealing with. And in this one, think about first you have to separate, and then you have to integrate. And right now, the separation, I think 80% of the sales of Unilever's food business is already separated. It's standalone. Think about the sales organization, manufacturing, R&D. Those are things that kind of come together and kind of reduce execution risk. But also think about market overlap. Now we're talking about the combining aspect of this. And so we see a lot of overlap opportunities where we're lifting and shifting great Unilever talent and ways of operating into a combined business.
Wait, how does that work with just making sure that the best talent stays on board? Do they need to move to Baltimore? I mean, it's a great city. I love Baltimore. But maybe you'd have people being like, absolutely no way I'm going there.
This is a global business, and we need people globally.
I wonder about a couple of trends in the food business that everyone has seen, right? The private label business, the white label business has gotten big. So how do you differentiate McCormick from, I don't know, Bowl and Basket or whatever, private label brand is sitting right next to it in the spice aisle?
It's the quality and the flavor of our products. So you think about the hot sauce category. Those are flavors that can't be replicated. And so people are really loyal to them. Think about Cholula or Frank's Red Hot. And in fact, they probably have many hot sauces in their pantry for different purposes. But you go over to herbs and spices. I mean, if you compare, sort of a cumin to a cumin, we have a very unique sourcing strategy that is really deep. We go all the way to the source, and we have a chain of custody from the farm. We work with over 54,000 smallholder farmers. And so we know exactly what that product is, and it prevents adulteration and makes sure that we have the right spec behind everything that we have. So it is quality in the jar that is the big differentiator versus everything else, because we have a very unique sourcing strategy.
I think there is this fear that consumers already having dealt with a lot of inflation are dealing with it even more acutely as gasoline prices go up. Have you seen any changes to consumer behavior over the past month?
I would not say over the past month. It's really been over the last couple of years. There's a real intersection with the need for value and also health and wellness. And consumers aren't going to give up on looking for both of those. So we put a lot of focus around that in the first couple of years that I've been CEO, and really make sure we have our price points right at shelf. We're working a lot with our retail, partners to make sure that we grow categories. And we think about volume growth. And that's been a big focus of ours. If you look at the performance of McCormick and Unilever Foods over the last 2 to 3 years, we're one of the few companies that have been doing that because we think we're hitting that cross-section of value and health and wellness.
I want to get into mayonnaise a little bit because I grew up in Bexley, Ohio. Yes. My grandmother would make us peanut butter and mayonnaise sandwiches.
Oh, I don't know how I feel about
delicious.
that.
It's delicious. But she wouldn't have used anything other than Hellmann's. And as a result, I never will try Mike's Amazing Lemonade or Duke's mayonnaise or whatever QP is, this Japanese mayonnaise. But other people are increasingly starting to branch out. And there's also like a hyper-local foods trend that's picking up. How do you look at this category, this all-important category of mayonnaise?
Well, when you look at categories like this, where you have big legacy, sort of iconic brand names like Hellmann's or like McCormick, those are important to consumers. But consumers also like to explore with flavor. They like to try new things. We understand this world of flavor a lot. And, you have to continue to be relevant. And you have to bring in innovation. You have to bring in new flavors. You have to think about, how does heat apply? And think about flavor trends. We know all about that. And so I see a world of innovation opportunity, whether it is a small, growing brand. Like, think about Cholula or Frank's Red Hot or My Mustard. Those are really great high potential brands around the world that we see a lot of growth. And so we see a lot more new penetration. But there's also innovation opportunities behind brands like Hellmann's where you're still going to want to be a loyal user, but it's also a lot of new flavor opportunities there too.
What's sort of the split between like your test kitchen coming up with new stuff versus inorganic acquisitions and finding little small, the kind of small local hyper brands out there? Do those look attractive to bring in new innovation, or is it kind of all done in-house?
Well, we consider both. Actually, as we think about growing the business, it is about growing the brands organically. That's really important. It's also important to grow through volume. And sometimes there are opportunities where you see brands like we did with Cholula a couple of years ago. We thought this brand has the ability to take off globally. That has to be in our portfolio.
What's next? I mean, would you want scale? You want more SKUs. Do you go after a J.M. Smucker? Because Jif peanut butter goes amazingly well with Hellmann's mayonnaise.
We're really focused very exclusively, and that's why I think is really the most important part of this combination is we're dedicated to flavor. And we've been very, very focused on that.
just very quickly, because we're almost out of time, but one of the things that's been remarkable about this very tense geopolitical moment that we're living in is that kind of the price of everything is dependent off energy, including plastics. What has that done to you? Packaging getting more expensive because of what's happening in the Middle East.
Well, we're certainly watching that closely, and the price of oil obviously affects a lot of that. We're finding a way to work through that. And every company is trying to find a way to make sure we work through that. But this is one where we have to think about value at shelf, making sure we also find other ways to offset those input costs. And that's the way we're dealing with this current situation.
Brendan, great having you on the program. Hope we can get you back on. And if you ever need anybody in your innovation kitchen, I'd be happy.
Okay.
Happy to
It's going to be all mayo and peanut butter sandwiches.
Can't wait.
Try it.
Can't
Try
wait.
it. I'm telling you. Brendan Foley, Chairman and CEO of McCormick. Let's get a check now on what's going on in the markets. We are looking at slight losses on the benchmark index. Well, 0.25% right now on the S&P 500, but to 67.65 right now. The NASDAQ down about 0.4%, a little bit of a bigger drop as we see bigger gains in the price of oil. Now, yesterday we had the S&P up 2.5%, so big gain there, and we had the biggest drops in oil in the crudes that we've seen since April of 2020. So the last time we saw oil down as much as it was yesterday was a global pandemic. Just to put into a scope for you the moves that we saw. Today we see NYMEX crude bouncing back, and it's gaining momentum, now up well over $100 a barrel at $102.33. That's for a WTI, as the world tries to deal with the blockage of Hormuz and does so by bidding for NYMEX crude.
Now, elsewhere, concerns around private credit continue. We learned this morning Carlyle out with a new funding of a 15.7% redemption request for one of its BDCs that limited it at 5%. And earlier this week, Moody's revising its outlook on the sector to negative. Now with redemption requests climbing and leverage stretched, concerns are growing that the boom may be losing its footing. Private credit investor Jeff Aronson of Centerbridge joined Matt and I earlier this week on why he thinks the focus has shifted away from what matters most.
I think what's happened over the past several years, the emphasis in private credit has been on growth. Grow, grow, grow. But things that credit investors should care about, like quaint terms like safety or risk or getting your money back, you don't hear that much about.
I'm so happy to say that joining us is one of the best private credit voices. It's Marc Pinto, the global head of private credit at Moody's Ratings. Marc, great to see you this morning.
Good to see you.
And I was just going through your you and the team's downgrade on BDCs, and part of it is about the outflows. And we've heard from so many funds that defend it and are just like, it's just about the headlines. It's the media scare. This will stop. It's not a big deal. Why is it a big deal to see these types of redemptions?
It's a combination of a number of different things. The market is going through a transition. It's not. It's a test of the market. The market's being tested, but it's not the test. It's not something like the Great Financial Crisis. But I think investors are feeling a little uncertain about what's happening at the private credit lenders. Private credit is being held to a higher standard. Why? Because it's been growing very significantly, like we just heard. We've seen concentrations build up, particularly in software. This market hasn't really been tested. It's not regulated like banks, but they're becoming as big as banks.
So I get the concentration risk and the lack of regulation as a risk also. What about these redemptions that we're seeing? Because we're starting to see bigger and bigger numbers. A lot of them have a 5% cap on redemptions, not really a hard gate, but some are enforcing that level where redemption requests go to 15% or 20%, or in some of the smaller funds at Blue Owl, as we saw earlier, 40%.
Well, I think it's a very important point that the structure of these BDCs is working the way it's supposed to. It's being a little frayed because of the somewhat inconsistent way that each one of the sponsors are dealing with this. There is a soft promise, as you mentioned, for them to release up to 5% of the assets of the fund on a quarterly basis, but that's decided by the board of directors. It can actually be zero. But as you've seen, it can be above 5%. So we're watching very closely how managements deal with this, how they deal with liquidity, leverage, and the overall construction of the portfolio. But what I would say is where you can have in a situation like this a run on the bank, you have a structural feature here where you can't really have a run on the BDC because they can stop those outflows because of the way the BDC is structured.
I know one of the ways, just thinking of banks, and that systemic fears come in, is the fact that banks do lending themselves to some of these private credit vehicles. JPMorgan among the ones who have said, listen, we're going to reevaluate how we look at these and how we value them. Is there a risk that banks pull back in their willingness to lend to private credit, and that alters this industry too in the availability of private credit financing?
I think it is a risk. It's a growing risk. But what you have to realize is that there's a lot of liquidity available to the BDCs today. Their loan portfolios mature at a fairly rapid pace that creates liquidity. They do have committed lines from many of the banks. So many of these lines are committed for a number of years, so it's not easy to turn off the spigot. They also have the ability to pledge some of their loans in a secured lending apparatus. So there is enough liquidity today, and again, they can manage through this, but we're going to see a period of elevated redemptions for probably the rest of this year and possibly longer.
I say, because you discuss in the note this idea that a lot of the redemption requests, they look like they're being prorated.
Exactly.
How do you see that playing out then?
Yeah, so if you didn't get your money this quarter, you're going to line up for next quarter. And it may take multiple quarters for these redemptions to get through the pipes. In the past, we have seen elevated redemptions, but it's usually lasted for 1 or 2 quarters. This one, we think it's going to be higher for longer in terms of redemptions.
So what's more important then? Is it liquidity or funding or the underlying asset?
All of the above. Liquidity, I think, is what we're addressing right now. When we look at asset quality, we're seeing some deterioration in pockets, but overall, asset quality has held up quite well.
Are those pockets software as a service?
I would say that it's really across the board. Software is in huge amount of focus. I mean, for many years, the concentration has built up in software, and it was viewed as terrific and tactical. It's been an outperformer for BDCs. Today, not so much. In fact, we spoke to one of the third-party valuation firms that look at the software exposures, and they told us that 70% of the valuations of the software companies or software positions that they look at had fallen quarter on quarter. It didn't sound like they were falling dramatically, but there is a reassessment of these particular positions.
Isn't that a bad thing, though? Because something like private equity, you can have some returns that aren't great and you have other things to make up for it. What happens when that occurs in a private credit portfolio where returns are usually within a range, to have one that underperforms, to have like a real stinker of a software business in there?
So a couple of things. One, returns are coming down at the BDCs, and the big private credit lenders who've been on this show have been talking about it. We've had a period of very strong returns. Returns are coming down for a number of reasons. One, last year, towards the end of last year, we saw the Fed cut 3 times, 75 basis points. Many of these loans are floating rate, so they're no longer producing the same amount of income. We're also seeing spreads that have been quite tight until recently. This is reducing profitability. What also, though, is a feature of this market is these are not bank loans. These are direct loans provided by the private credit lenders. And they have certain tools at their disposal to manage through some borrowers' struggling periods, right? So at a bank, when something becomes non-performing, they reserve against it and then they write it off. At a private credit lender, it's more of a nuanced process. And so, the stinker, as you mentioned, may not be as difficult a situation to deal with as you might have seen in a banking construct.
Marc, just quickly, when we go through this period that the redemptions are going to last longer than historically,
right.
When we come out on the other end of it, do you think that most of all of these funds survive, or will we look back and say, wow, actually the universe shrank a lot because of this period of stress?
It's a good question. Whether every single one of them survive remains to be seen. But what I think we will see on the other side of this is more disclosure. We'll see more discipline. And I think we'll see more direction, potentially from regulators. Not that I see a lot of regulation for the private credit industry of itself, but maybe through a back door, through insurance regulation or banking regulation, because the financial services sector is becoming much more interconnected, as you mentioned earlier, and regulators and investors are asking for more disclosure. In the current period of time, maybe it's a little bit too little, too late, but I think on the other side of this, you will just see a lot more disclosure.
Marc, let's do this again soon.
Absolutely.
So
Thank
great
you for
to have
having me.
So great to have you on, Marc Pinto from Moody's Ratings. Coming up, a hot take from billionaire Thomas Peterffy on inside trading. Insider Trading Odd Lots co-host Joe Weisenthal and Tracy Alloway join us next. This is Bloomberg Open Interest.
Thomas Peterffy, the billionaire, founder, and chairman of Interactive Brokers, is making waves with a controversial take on insider trading.
I'm in favor of not having any rules against insider trading. I would like all the information out there as soon as it's available. Because, look, as a society, we're better off knowing as soon as possible anything that is knowable.
That was Thomas Peterffy speaking on an interview with the Bloomberg Odd Lots team, the podcast hosted by Joe Weisenthal and Tracy Alloway. We are lucky enough to have them here on set with us now. Thank you so much for joining us. I know this podcast just went out like 4 or 5 hours ago.
Breaking news.
So fascinating to me that, you know, the guy who owns Interactive Brokers would say this, because I imagine, first of all, if insider trading were allowed, very few people would do any trading, right?
This was my thought. So, I mean, the context came up in the question of, because they're getting into prediction markets, and this is one of the criticisms or concerns, like insiders. And it's like, well, how do you deal with that? And this was my thought, which is that if you think, like, you know, if we're all trading, the four of us, and I think the three of you or two of you or one of you has information that the other of us just can't have, I'm just going to move on to something else in my life. I have better things to do than to trade with people who have a big information edge over me.
But to me, what he said is like more of an argument for why the job that we do is important, that like we get information. I don't understand the mechanism of someone insider trades and then what, like announces to the world this piece of insider knowledge that they have.
Well, okay, so I've heard arguments in favor of allowing insider trading before. They usually tend towards like very EMH, like pure EMH libertarianism. I haven't heard an argument, which Tomas actually makes, which is along the lines of like, well, everyone's doing it anyway, so let's just allow it. Like his whole point was, well, we know if there's a deal going through, bankers, lawyers, the lawyers' wives all know that it's happening, and so trying to stamp out that activity is futile. I'm not so sure.
I mean, it would obviously improve price discovery, right?
Well, it would if liquidity were sustained. But to your point, like if no one is like trading because we think that there's like insiders who just have like their information edges massively, do we really have improved price discovery?
Yeah, but aren't people insider trading on prediction markets, and we still get plenty of liquidity there?
Plenty?
I think the difficulty is we still don't know what counts as insider trading on prediction markets.
I mean, this was actually, for what it's worth, like the context of the broader thing, which is that Tomas is very bullish on prediction markets. He thinks they're going to be institutionalized, right? But there's this chicken and the egg problem, which is that some of these instruments, even if they're named something potentially economically relevant, will there be a recession in 2026? Serves no purpose whatsoever if the total volume is like $20,000 worth of trading. It might be interesting for us to look up a chart, we can quote it, but that's not like a useful economic instrument. So like the real conversation was solving this chicken and egg problem. But I agree, like to my mind, it's like, if you want to solve that chicken and egg problem, if you want there to be mass liquidity and so forth, my gut is that, you know, you probably want to have like fairly solid like rules, such as with the stock market. But again, like Tomas is a billionaire, successful like trading entrepreneur, and I'm not.
He's made all his money. But it reminded me of when Chip Wilson came on with Stephanie Ruhle and said, like, only beautiful people should wear Lululemon pants, right? Which I guess I see his point, but then far fewer people would buy Lululemon pants, right?
Oh, yeah.
If only the people who have, or if the people who have the information, say you're going to call a ceasefire in Iran, and then you allow the people who know that to buy that contract on Polymarket. I'm not going to go, since I don't know, buy any contract in Polymarket. So there wouldn't be the other side. It takes both sides to make the market, right? I mean, nobody would go on Interactive Brokers.
This is also an issue, which is a ceasefire in Iran contract could be a very useful instrument for traders trading oil and so forth. But it does raise national security concerns if a small group of people is told, okay, there's going to be a ceasefire and or a failure of the ceasefire, and then suddenly you get this big price movement.
And you can see who's betting on it and who's been successful in the past.
Yeah, so suddenly it's like, oh, wow, the odds of a ceasefire just collapsed. This is something, it's like, okay, yes, I guess, like, great. Now we have more information, including people who are, like, involved in war.
I was gonna say,
is that information you want, like, distributed, disseminated rapidly, not necessarily so?
It seems like prediction markets realize this because, I mean, there was the whole controversy of, like, you can't bet on death, removing nuclear war bets. So it feels like something that, like, live in real time that these exchanges are trying to deal with.
Well, this is the other thing that's really notable about the conversation. So what Peterffy is trying to do with his particular prediction platform on Interactive Brokers is aim it towards institutionalized investors, right? So institutional investors, not institutionalized.
Maybe that too.
Institutional investors. So like the big professional ones versus like the retail ones who are trading mostly on Polymarket and Kalshi at the moment. And I think there's a big question mark. All this sort of sketchiness that we're discussing here, is that going to be something that attracts professional investors? Like, if they don't even know what the definition of insider trading would be on a prediction market platform, are they going to be comfortable trading inside?
Well, didn't Cliff Asness come on Odd Lots and was like, yeah, we might do this?
Yeah, well, he was talking about sports betting for the most part, but yeah.
No, it's pretty clear, especially I think if you like talk to like any of like the prop shop trading firms. Like, look, if there's a market somewhere, they're gonna like it doesn't matter. You know, there's going to be a liquidity, and smart people are going to find opportunities for identify mispricing systematically. And they'll all do it if the volume ever gets solved.
Joe Weisenthal, Tracy Alloway from Odd Lots, thanks for joining us. That's it for the program. This is Bloomberg.